Hello everybody. Welcome to the AUD689 Zoo and Aquilin Tour. Today we will be visiting the animals of Audit risk materiality sampling. Please refrain yourself from feeding the animals, and if you wish to take a picture, be aware that you are not using flash photography.
The first topic to be discussed is on the concept of audit risk and materiality. Audit risk is the risk that the financial statements are materially misstated but expressed wrongly by an auditor. For example, the auditor issued an unqualified audit report even though the financial statements are materially misstated. There are three types of audit risks, which known as inherent risks, control risks, and detection risks.
For materiality, item is considered to be material if it affects the decision of financial statements user. For example, expenditure with a cost of Rm1 is deemed to be immaterial with a company that turned a revenue of Rm1000. Second topic is on the type of risks. Firstly is control risk. Control risk arise due to absence or failure in the operation of control of a company. Internal control is necessary for a company to prevent and detect fraud or error. Control risk is higher when there is no internal control. Detection risk. It is a risk when auditor failed to detect material misstatement in financial statement. To detect material misstatement, audit procedure needs to be applied. Detection risk occurs when there is a limitation of audit. For example, the use of sampling for the selection of principles. To reduce detection risk, auditor need to increase the number of sample transaction for testing. Inherent risk. Inherent risk arise due to error or omission other than the failure of control. It is higher when transaction of an entity is complex as it needs high level of judgment. Hello everyone, let's visit our giant reptiles, the crocodile, but before that, let's study on the relationship of materiality and audit risk. Auditor must fully aware what contribute to the financial statement materiality misstated to help them decide what items to examine and whether they may use sampling or analytical procedures. Materiality and audit risk has an inverse relationship, which means, the higher the materiality level, the lower the audit risk. The lower the materiality level, the higher the audit risks. Next, we will be visiting the vibrant colored animal, the peacock. It is associated with quantitative level and basis that can be used for valuing materiality. Fun fact. Male peacocks are called pheasant while female peacocks are called peahen. Materiality can be broken down into three, which are overall materiality, performance materiality, and specific materiality. Overall materiality. It can be defined as the amounts which are below the materiality of the whole financial statements. Before determining the level of overall materiality, the following factors should be considered. 1. The main or major users of the financial report. 2. The important information that will affect that organization's economic decision-making and the conduct of responsibilities of the people inside the organization. 3. The qualitative information that may create impact on the users of the financial report when it is related to the materiality. Overall materiality can be valued or calculated by 1. Benchmarking. Depending on the user's acceptance and tolerance for misstatements. And 2. Weighting factor. Depending on the type of entity, performance materiality. It can be defined as amounts set by an auditor which is less than the materiality level of a particular class of transaction, account balances or disclosures. It is set based on the overall materiality to ensure that auditors have a margin for any undetected misstatement that possibly occur during the audit engagement. Sliding scale is used as a basis to estimate engagement risk that might be associated with the audit client. It is also based on the professional judgment of the auditor and how well he or she understands the entity. Specific materiality can be defined as a materiality level for a particular and specific class of transaction, account balances or disclosures. It is valued by taking into consideration qualitative factors. Hello everyone, welcome to Aquaria. We need to focus on the factors influencing determination of materiality. There is no complete concept for materiality as to decide whether the items are material or not material is based on auditor's judgment. In the most cases, auditors will design the audit to provide reasonable assurance of detecting quantitatively material misstatements. According to ISA 320, the factors that will influence the determination of materiality are the entity's condition and quality control, the extent and nature of misstatements, the significant information needs by the users. Now let's take a look at this not-so-crabby crab, the application of audit risk model to audit work. Audit risk model is used by the auditors to manage the overall risk of an audit engagement. Auditors proceed by examining the inherent and control risks related to an audit engagement, at the same time, understand the entity and its environment. Detection risk forms the residual risk. After considering the inherent and control risk related to the audit engagement and the overall audit risk that the auditor is willing to accept, where the auditor's assessment of inherent and control risk is high, the detection risk is set at a lower level to keep the audit risk at an acceptable level. Lower detection risk may be achieved by increasing the sample size for audit testing. Welcome to the Penguin Kingdom. Before that, here is the consideration of analytical review procedure. In planning of analytical procedures, it generally considers comparisons of financial information and relationships. The financial information will be compared with the prior periods for historical data, the budgets and forecasts for future-oriented data, the predictive estimates as for example the annual depreciation charge and industry averages. Meanwhile, relationships refer to elements of financial information which are expected to adhere to a predicted pattern, and financial and non-financial information. Think twice before you dive in because the shark is coming. Now, before we end this tour, you need to know the sampling in audit. Sampling involves looking at less than 100% of transactions. Auditor use sampling to obtain minimum audit evidence as a technique to make a valid conclusion. There are two types of sampling approaches: statistical and non-statistical sampling. Statistical sampling use of probability theory to evaluate sample results. It may be used when there is a large population. There are three types of sampling under statistical sampling: attribute, monetary unit and classical variable sampling. Attribute sampling is the estimation of population that possess a specified characteristic. It used to determine whether internal control is reliable. Monetary unit sampling is used in the estimation on the amount of misstatement of a transactions, commonly used for test of overstatement errors, suitable for low error rate population of sample results. Classical variable sampling used normal distribution to examine the population's characteristic based on sample data. It's determine whether account balance is materially misstated. Non-statistical sampling, also known as judgmental sampling, is when auditor uses his professional judgment to select the sample in conducting audit test. Auditor believes that the sample selected may provide useful information.